Well, I mean, probably the reason behind that superior returns over the last 5 years is I think the income component. I don't think there's any great surprise, and it's probably more a reflection, I would say, of poor performance in retail and office than any particular outperformance in logistics. I would say logistics returns are defensive. I mean, they've been quite consistent. They're less volatile, and I think that appeals to a certain type of investor. I mean, our investors are looking for, a lower risk product. They want core plus, they want decent dividend distributions, and they want some protection against inflation. I mean, it's simple. They can't get that from bonds because they're worried that inflation will kick in 5 years. But being in a physical asset, they feel comfortable, and that's why our emphasis is very much on modern logistics, because to us the supply chain will be resilient, and I think Joseph made a good point about the decoupling from the economy, because actually obsolescence, people going into more efficient space, that continues. It shouldn't come as a great surprise that in a low growth environment, supply chain efficiency, maximizing that profit margin, which is probably already skinny, is very, very important. And so, this optimization of the use of your assets and the way you move your products around, it is very defensive. I mean, will this continue? I would say the returns in absolute, on an absolute level will be consistent. I think, it has always been a low rental growth environment, but, on the continent you get some inflation-linked leases, which is important. But I think you'll probably see, retail and office eventually in, say, 3 to 5 years start to recover and perhaps perform more strongly on a capital growth perspective. But, we're quite happy keeping it simple and looking for, low double-digit returns, with the majority of which coming through contracted income. I don't feel particularly comfortable investing at 5-6%, relying on hitting 10-12 because, I'm going to get capital growth. It's still a choppy economic environment, and I like to keep it safe.
Even if you look back 10 years, you see that returns on logistics, income returns were outperforming the other real estate asset classes. If that were to change going forward, that might actually be good news, because it might mean that cap rates are compressing in logistics. But look, I think the environment is quite interesting. Capital values have not recovered since 2008. We have seen that rental rates have gone down in nominal terms, but so definitely in real terms as well. It's very much a market that has this sort of a dichotomy between prime and secondary, whereas there's definitely skewness of demand both from occupiers and investors towards prime. And you also see that there's a quite substantial difference in pricing between short leases and long leases in today's market. But to answer your question, yes, I think it will continue. I don't see a reason why logistics wouldn't remain performing as it has been.
And do you think that will bring in different sorts of investors, maybe investors who typically before had a much lower risk profile, were maybe investing in bonds, but are thinking about it from that kind of return point of view, low risk return point of view?
I think today we're seeing that already. I think people realize that if you invest in logistics and you invest in a sort of diversified platform that gives you well spread exposure, which I think is important in logistics, you have a quite stable income return, and obviously given the height of the yield that you get, it also provides some buffer.